Beyond Bitcoin, what does the future of crypto look like? Well, for years it seemed obvious. Ethereum, Solana, maybe some other layer 1s and layer 2s. But now, stablecoin issuers and fintech companies are launching their own blockchains. And suddenly, the future of crypto doesn't look as clear. After all, these new chains aren't new crypto projects. They're private and permissioned rails made by TradFi and fintech companies.
What did you say?
So what happens if, or when, all the things that made people bullish on cryptos like ETH and SOL disappear because of these new chains? Today, we're diving into the rise of company blockchains to figure out what these giants are building and what it could mean for the future of major chains. My name is Guy, and you're watching The Coin Bureau. Okay, first things first, you need to know that nothing in this video is financial or investment advice. It's purely educational content intended to help you navigate the changing world of crypto. If you want more of this kind of content, then smash that like button, subscribe to the channel, and ping that notification bell so you never miss another update. Now, let's start with Circle, a company that helped bring regulated stablecoins to the mainstream and turned USDC into a pillar of Ethereum's DeFi ecosystem. Chances are, if you've used crypto, you've come across USDC. But Circle didn't actually begin as a stablecoin company. Back in 2013, Circle's founders wanted to build a better payments network using Bitcoin. That didn't work out, so Circle pivoted to Ethereum and launched USDC in late 2018, just as stablecoins were starting to heat up. The timing was perfect, and today USDC lives on 24 different blockchains, from Ethereum to Solana to the XRP ledger and beyond. Now, Circle's goal has always been straightforward. Put USDC wherever digital dollars are needed. But just being everywhere apparently isn't enough anymore, because in August, Circle announced its biggest move yet, a brand new blockchain called Arc. And Arc isn't just another sidechain or a fork of something else. It's Circle's attempt to build a whole new foundation for stablecoin payments, one they control from the ground up. So, what makes Arc different? Well, for one thing, it is fast. We're talking 3,000 transactions per second with finality in less than a second. That means no more waiting around for confirmations, no more wondering if your money really arrived. But what really sets Arc apart is how it handles fees. On Arc, USDC isn't just another token. It's actually used for gas. So, when you pay transaction fees, you're paying in dollars. This makes the user experience much simpler, particularly for individuals. And not only that, but gas being priced in USDC means the transaction fees themselves are low, predictable, and simple, exactly the kind of thing businesses and institutions want to see. Arc even includes a built-in FX engine. So if you need to swap stablecoins or settle transactions across currencies, you can do it instantly, on-chain, without ever leaving the network. Another problem that Arc solves is privacy, which is another key sticking point for institutions. Arc's opt-in privacy controls mean a business can keep certain transaction details confidential while still staying compliant with regulations. In terms of tech, Arc's backbone is a consensus algorithm called Malachite, inspired by Cosmos's tech, which relies on a permission set of just 20 validators, all chosen by Circle. Now, obviously, this makes Arc pretty centralized compared to most public blockchains. Circle says they plan to open things up to more participants over time, but at launch, control will be firmly in their hands. And Circle is also bringing all its assets and products into the Arc ecosystem. Earlier this year, they acquired Hashnote to bring yield-bearing USYC into the mix, and they plan to integrate their full suite of services, that is, wallets, payments, their EuroPeg stablecoin EURC, minting, and cross-chain transfers. Arc is designed to tie all of this together. And it's expected to roll out in stages, with the public testnet launching later this year and the mainnet beta scheduled for 2026. And if you want to learn more about Circle, you can watch our video about their recent IPO, which we covered right over here. Now, if Circle is the king of onshore dollars, then Tether is the king of offshore dollars, which is a much bigger market. That's why Tether's USDT is the world's biggest stablecoin, and for years it's been the lifeblood of global crypto trading, remittances, and even savings, especially in jurisdictions that have a hard time accessing US dollars. But while most people think of USDT as living on Ethereum or Tron, Tether has always been quick to move wherever fees are lowest and transactions are fastest. Historically, it's Tron that's handled most of USDT's volume because transaction fees on Tron are so low. But now, Tether is deciding to take matters into its own hands. The stablecoin company recently backed not just one, but two new blockchains of its own, Plasma and Stable. Plasma is a completely new Layer 1 blockchain built from the ground up for one purpose: stablecoin payments. It's EVM compatible, which means developers can build on it using the same tools as Ethereum, but it's got some very unique features under the hood. First off, Plasma is designed for speed, though the exact TPS and finality figures have yet to be announced. Plasma also has zero fees because Tether covers the gas costs for every eligible transfer. For global remittances, especially in emerging markets where every cent matters, this could make a real difference. If you're doing something more advanced than a basic USDT transfer, like using dApps or smart contracts, you will still need to pay gas, paid in USDT. That said, though, you will apparently be able to use any token to pay for fees, with the token being converted into USDT to cover the transaction costs behind the scenes. Then, in terms of privacy, Plasma will be introducing confidential payment features, allowing users to shield transaction details like amounts and receiving wallets. Under the hood, Plasma will use a consensus algorithm called Fast Hot Stuff, which is also based on Cosmos tech. It's also rolling out a Bitcoin-native bridge, meaning users will be able to move real BTC directly onto Plasma and use it in smart contracts, DeFi, or as collateral for stablecoins. Now, Plasma has already gone through several funding rounds, including an impressive $373 million public token sale, and plans to roll out its mainnet beta in late 2025. Other features like privacy and the aforementioned BTC bridge will be added over time as the network evolves. There'll also be over $1 billion in USDT liquidity lined up for launch, so users and businesses won't have to worry about slippage or thin order books. But Tether knows not everyone needs the same thing, and that is where Stable comes in. Now, in case you forgot, Stable is the second major blockchain project backed by Tether, and it has a different focus from Plasma. Stable's goal is even more user-friendly peer-to-peer payments. Unlike Plasma, the threshold for paying fees is slightly different on Stable. For example, if you want to send USDT to a friend, there's no gas fee. Like Plasma, Stable is built to support low fees, sub-second finality, and full EVM compatibility. And Stable also promises features that matter to institutions, like confidential transfers to keep sensitive information private, guaranteed block space so businesses don't get crowded out, and seamless integration with cards and merchant payment tools. For developers, meanwhile, the chain will support cross-chain interoperability, so USDT can flow freely between Stable and other major blockchains. Now, of course, all of this is being rolled out in phases, with the first features expected to go live this quarter and more advanced capabilities planned for release over the coming year. And speaking of which, if you want to make the most of this year's bull run, then be sure to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cashback on deposits of up to 75% on the best crypto exchanges. These deals won't be around for long though, so take advantage of them ASAP using the link down below or the QR code on the screen. Okay, next up, let's talk about a company you might not have expected to launch its own blockchain, Robinhood. Now, this is a firm that took commission-free stock trading mainstream and became a household name during the meme stock boom back in 2021. But over the last year or so, Robinhood has expanded far beyond stocks. Their ambition now is to become a financial super app covering banking, retirement saving, crypto, credit cards, AI-powered portfolios, and much more. But lately, they've been making big moves into tokenization. Robinhood's big new plan is to bridge traditional finance and crypto by bringing real-world assets like US stocks, ETFs, and even private equity on-chain as tradable tokens. And in June 2025, they unveiled tokenized stocks for their European users. But to power this tokenized asset ecosystem, Robinhood is building its own blockchain rail called Robinhood Chain, a customizable EVM-compatible network. The goal is to combine the speed and convenience of modern blockchains, the regulatory guardrails of traditional finance, and the reach of a global consumer app. But what also makes Robinhood Chain interesting is how it aims to blur the lines between old and new. The chain will start by settling trades both on traditional rails and blockchain rails. So, when legacy markets are open, your order will be handled as usual. But when they're closed, on weekends say, or holidays, or after hours, then Robinhood will route the trades using tokenized stocks on Bitstamp, their newly acquired crypto exchange, or using their own chain. And it doesn't stop there. Robinhood is actively developing self-custody features. So soon, users will be able to move their tokenized stocks off the Robinhood platform and into their own wallets, thereby taking full control of their assets, at least in theory. And Robinhood's also opening the door for developers and other companies to build on its chain, with DeFi, lending, and real-world asset marketplaces on the horizon. Now, under the hood, the Robinhood chain is being built on the Arbitrum Orbit tech stack, a customizable Layer 2 solution for Ethereum. The network is being designed for low fees, fast transactions, and, crucially, will give Robinhood control over who runs the sequencer node and how transactions are processed, so they can fine-tune for compliance and prevent issues like front-running. Looking further ahead, meanwhile, Robinhood's tokenization roadmap doesn't stop with public stocks and ETFs. They're also aiming to tokenize private equity, bonds, real estate, and other alternative assets, thereby making them fractional, tradable, and more accessible than ever. Over time, the Robinhood chain could power a new breed of marketplaces where ownership, collateral, and even things like dividends or corporate voting all happen on-chain. Now, to refresh your memory, the rollout of tokenized stocks has already begun in the EU, initially on Arbitrum, and global expansion is expected to follow as Robinhood works towards launching its own dedicated chain, though the exact timelines here are unclear. In any case, if you'd like to explore tokenized stocks in more detail, then be sure to check out our dedicated video on them right over here. Okay, now let's turn to a name that might not scream crypto at first glance, but probably affects your life more than any crypto ever has: Stripe. If you've ever paid for something online, maybe a ride, a subscription, or even your morning coffee, there's a good chance that Stripe was quietly moving the money around in the background. Now, Stripe's story is kind of classic Silicon Valley. Two brothers, a shoestring prototype, and an obsession with making payments as easy as possible for businesses and developers. Fast forward to today, and Stripe is a global payments giant. Last year alone, they processed over $1 trillion of payments, powering checkouts for some of the world's biggest brands. Think Google, Amazon, Shopify, Airbnb, and even Robinhood. But Stripe isn't stopping with cards or bank transfers. After first being dismissive of crypto, Stripe has pulled a complete 180, especially when it comes to stablecoins. And earlier this year, this change in opinion turned into a change in action. First, Stripe rolled out stablecoin payments and accounts in more than 100 countries. That means businesses can accept Circle's USDC and Bridge's USDB just as easily as dollars or euros, instantly, globally, and with minimal friction. But what really sets Stripe apart is how invisible they make their crypto rails. If you're a Shopify merchant, you just tick a box in your dashboard and suddenly you're accepting stablecoins from anyone, anywhere. And this is made possible by Stripe's recent crypto acquisitions. Over the past year, they've acquired Bridge, a stablecoin payment startup, for over $1 billion, and wallet developer Privy. And as you might have guessed, Stripe is also building its own blockchain, Tempo. Now, Tempo is still operating in stealth mode, and it was first revealed through a job listing earlier this summer. What we do know so far, though, is intriguing. In short, Tempo is designed to be a high-performance, payments-focused Layer 1. It's EVM-compatible, being built with help from Paradigm, one of the biggest crypto VCs, and led by Stripe board member Matt Huang, but the exact technical details and launch dates are yet to be revealed. So, why build a blockchain at all? Well, for Stripe, it seems to be about controlling the entire payment stack. Instead of relying on Ethereum, Solana, or anyone else, Stripe can now route payments, issue stablecoins, and serve merchants on rails they own and operate. And while Stripe hasn't said this outright, their end goal seems clear: making stablecoin payments as seamless, global, and programmable as using a credit card. If they succeed, the impact here could be huge. Millions of businesses, from big tech companies to small shops, could quietly move to stablecoin rails for payments, payroll, and remittances, often without even realizing they've stepped out of the old financial system. Now then, let's zoom out for a moment and ask the big question. With all these new private blockchains launching, where does that leave the major crypto chains? And more specifically, where does it leave Ethereum? It's easy to forget that Ethereum's original superpower was stablecoins. USDC and USDT were born as ERC20 tokens, and their adoption basically forced every major exchange, wallet, and DeFi protocol to use Ethereum's infrastructure. For years, this has made Ethereum the heart of crypto's payments and savings ecosystem, with so much activity that the resulting high fees became something of a meme. But times are changing. Today, the very companies that facilitated Ethereum's rise are building their own chains. Custom, high-speed blockchains designed to do exactly what Ethereum did best, but faster, cheaper, and, crucially, under their own control. Circle, Tether, Robinhood, Stripe, these aren't scrappy startups. They are giants, each with their own customer base, regulatory relationships, and global reach. And this presents multiple risks for Ethereum. First, stablecoins. If USDC activity shifts to ARC, or USDT flows move to Plasma and Stable, then Ethereum risks losing its role as the primary payment rail. And it's not just about a few users moving to another chain. We're talking about the backbone of DeFi, cross-border payments, and even basic on-chain savings moving off of Ethereum. Second, user experience. Most users, especially outside of the crypto bubble, don't care about decentralization or the philosophy behind blockchains. They want payments that are instant, fees that are near zero, and transactions that work 99.99% of the time. These company chains are being built exactly for that. They sacrifice decentralization for an upgrade in speed, privacy, and user experience. For many, that is unfortunately a trade worth making. And third, there's regulation. With new global rules like the Genius Act and Europe's MiCA, we're seeing megabanks, payment giants, and fintechs race to issue their own stablecoins and build their own rails. If JP Morgan, Citibank, or even Amazon launch their own chains, then the competition for Ethereum only gets fiercer. And then there's innovation. Ethereum sits in a kind of awkward middle ground. It's not as decentralized as Bitcoin, but not as fast or user-friendly as Solana, Aptos, or these new payment-focused L1s. Layer 2s help, but the mass market may never care about the difference between an L1 and an L2. They just want things to work. And this isn't just about Ethereum either. The same existential questions apply to other major chains that host stablecoins and payments, especially Solana. Right now, payment processors like PayPal have chosen Solana as their de facto blockchain for things like PYUSD. But there's nothing stopping a company like PayPal, or any major fintech, from launching their own chain further down the line. And if that happens, Solana could face the very same existential risks as Ethereum, losing fee revenue, network effects, and ultimately, core user base. Now, coming back to Ethereum, there's no question it still has serious strengths though. It remains the most battle-tested smart contract platform out there, with the deepest DeFi and real-world asset ecosystems and a level of institutional trust that few blockchains can match. But as more activity starts to shift towards specialized corporate-backed chains, some of those powerful network effects that once set Ethereum apart could begin to fade. It is important to remember, however, that Ethereum isn't being pushed out of the stablecoin game altogether. Every chain we've talked about today is EVM compatible, and some, like Robinhood chain, are even built directly on Ethereum's Layer 2 infrastructure. So perhaps what we're really seeing is a shift. Ethereum is moving towards high-value, high-trust use cases like real-world assets and large-scale settlements, while day-to-day payments and rapid-fire transactions may increasingly live on new purpose-built rails. One thing is clear though, the next chapter for Ethereum and for stablecoins is going to be very, very different from the last. And if you want the latest updates on Ethereum and how it staged its impressive comeback, then check out our video on that right here. And if you haven't subscribed to the channel yet, you can do so right over here. Okay, thank you all so much for watching, and I'll see you again very soon. This is Guy, signing off.